All right, what's up, y'all? Can I be seen yet? Okay, I got my camera on yet? Camera is not on. Start video. All right, there we go. He is I and I am him. What's up, y'all? Thanks for joining me. About to start in a few minutes. Gotta get this camera locked up. What's up, y'all? If you're on what's that thing called? Instagram, right? Join me on YouTube. I got two cameras going at once. All right, all right. Hey, what's going on? Dibs, the realtor, pathways. All right, it is 8 o'clock. So appreciate you guys showing up on time. I'm sure folks will trickle in, but I respect everyone's time. So I'm going to start right at 8 o'clock. So let's jump right into the presentation. Okay, cool. If you guys have questions, you feel free to drop them in the box. I'll try to look at the questions maybe every 15 or 20 minutes. They're about 60 slides, so this may go for about I don't know, 90 or so minutes. Sometimes some of the slides are long-winded, so you know how that goes. One more thing before I start. Sorry. Yeah, if you guys got questions, just drop them in the box. Like I said I'll answer them as they as I see them, right? So that's how that'll go. Okay, cool. We are starting now at 8:01. It wasn't too late. Boom. Okay, first and foremost, like, who in the world am I, right? Some of you guys may follow me on IG, some of you guys may find me on Instagram. So I want to just introduce myself really to begin with. So my name is David. I'm a real estate agent here in the great state of Texas, as the locals like to call it, Dallas specifically. I'm a realtor. I've actually been licensed for about 14 days as far as like the realtor side, but I have a lot of experience in the mortgage industry and in underwriting. So I like to say I'm kind of like a guidelines nerd. I know a lot about mortgage guidelines, pretty more than most mortgage professionals, honestly. And honestly, obviously more than I think 99.9% of realtors, right? That's kind of like my bread and butter. That's my differentiating factor. I think I have the ability to explain mortgage guidelines in layman terms as well, because I used to be in the sales part of the mortgage industry, but now I'm in underwriting, which is a little bit more dry, but it's all good. So I personally own like 3 homes, 2 rentals. I always like to point that out because I think there's a difference between real life experience and like book experience. And so I always don't put that out. My degree is in finance. I went to the United States Naval Academy, so I spent 6 years in the military as well. I'm from the DMV. That's DC, Maryland, and Virginia, if you don't know about that. I'm a Navy veteran as well. And if you guys got questions, you can just email me at hello@houserichshow.com. I will, there's a 99% chance or 90% chance I answer your email. Some of them are just like, sorry, why does this automatically let people come in the room? Sorry. I gotta admit people as they come in. This is, all right. Okay, sorry about that. And so you can just email me at hello@houserichshow.com and I will I'll answer your question, like I said, to the best of my ability, right? Sorry, I did not put this on auto join. My apologies. So I gotta click every single person to come into this webinar. All right. All right, let's get that out of there. There we go. So you can just email me there, right? And so what are some resources for me, right? So you can email me, you can check out my podcast, you can check out my YouTube channel as well. You may be watching this on YouTube, so big shout out to you. I appreciate the likes over there on YouTube. Big shout out to you guys. I got a Facebook group. You can click the link in my bio on Instagram or just email me to join my Facebook group. But here's the thing about that Facebook group. It's for you guys. Like, I'm not in there just to talk. Like, if you guys got questions, I will answer them. I'll monitor the questions, but I don't post a lot in there, but I am present. If anyone asks a question, I will answer the question within like probably like within a few hours, because I do get notifications, but I don't really hang out in there. Also got another YouTube page. If you're like in Dallas, I just started. It's like, what's Dallas like? Because I want to tell you about, what Dallas is like, right? And so that's like a Dallas specific YouTube page. So or you can connect with me There's a link in my bio on Instagram as well. You guys can just schedule a one-on-one, especially if you're in the Dallas area, right? Or if you're anywhere, you can check me out as well. And so if you're not in Dallas, so the brokerage I'm at has like a national like concierge service. So we can help you out literally no matter where you are, whether you want to find an agent, you want to pack, you want to do movers or anything like that. So we can help you no matter where you are in the United States. So don't be afraid to hesitate to reach out, schedule a one-on-one to see how we can help you. And tell a friend to tell a friend, right? That's what it's all about. So this is what we're going to talk about in this presentation. We're going to talk about perspectives. Because I want to have to, I want to jump back a little bit and be like, hey, what's going on actually in the market? Because you see a lot of hyperbole as far as folks saying the market is crashing. It isn't crashing. Rates are high. Rates are low. Like, what does that actually even mean? I want to give you kind of a perspective on a step back and look at the big picture, right? I want to talk about mindset, kind of like the mindset you need to have as far as like purchasing a home. What goals I think you should be setting, from my opinion, as a potential home buyer. We're going to talk about loan programs, how to find your perfect home price, how to read a loan estimate. Very important. You don't know how to do it, even though you may think you do. How interest rates works, a lender realtor relationship, interviewing realtors and lenders, 30-year versus 15-year mortgage, big banks, why you need to shop rates, loan process. Probably could have read that yourself. I didn't need to read that out loud. But let's keep going. So first off, let's talk about some perspective. So I want to say, hey, what's going on with rates? Like, really, what's going on? So I'm going to talk about the cost to borrow money in the Federal Reserve and why rates are higher now than you saw them maybe in 2020 or 2021. So this cool chart right here in this mustard yellow, it's basically the cost to borrow money that the Federal Reserve has set for banks to borrow money, and then banks, of course, pass that savings or lack thereof savings along to you, the consumer. And so why were rates so low like in 2020 and 2021, right? Well, because the cost to borrow money was almost zero. I think it was like a quarter of a point or half of a point to borrow money. And so that's why rates were in like the high twos and the low threes, because it was very cheap for the banks to borrow money, so they passed that non-cost along to you. Now rates have shot up through the roof, because you can see the Federal Reserve, I think last year, they raised the cost to borrow money or the benchmark rate like 8 times, I want to say. And there were a couple, they were like 4 75-point jumps. And so the cost to borrow money, they're trying to shoot between like somewhere between like 4.5% to 5%, right? And so once again, that's the cost for the banks to borrow money. That is not your cost to borrow money, because the banks, like any business, wants to make money. So that's why rates are a little bit higher than you may have seen them earlier in the year. So that's kind of a high level overview of what's going on there. All right, so the Federal Reserve is trying to get inflation down to 2%. We're at like 6% or somewhere around there right now, so we got a ways to go. But once again, step back. This is where rates have been since like over the course of the year. So they go up, they go down, they go up, they go down. That's how rates work. There's never like a flat line as far as rates. So you may hear folks say, "Oh, rates are going down." They go down, then they go back up. That just kind of is what it is, right? All right. And so, but this is a very important chart I want you all to see as well, like rates the last 30 years. So let's look at 2020. Where's my highlighter at? So 2020, 2021, right? That was this point right here. So when you hear folks talking about like 2%, 3.5% interest rates, you hear folks like me saying those are never happening again. I can't predict the future, but like nothing in recorded history recently says that rates will ever be down at this low again. I mean, look at this chart of rates going back to 1970 or probably 1970-ish, right? Nothing was ever as low as we had the last 2 years. So if you missed out, you just missed out. Like, it's nothing you can do about that right now. And so where are rates going? I don't got a crystal ball. But there are folks that do a little bit more research on this topic than me, such as Fannie Mae is one of them. And this is where Fannie Mae predicts that rates may go through the course of 2023. Maybe they may drop down to like the very low sixes in Q4. I've seen a report, I think Stanley Morgan did, that rates may drop down to like the very high fives, like 5.875 threshold around around Q4 2023. I want to point that out to say that my camera fell. So I want to point that out to say, one second. Okay, that was awesome. All right, this is definitely live, right? So I want to point that out to say that who knows where rates are going to be going in sorry, I lost my train of thought. So who knows where rates are going to be going, but it seems like all the data says that rates are going to be like in the high fives to low sixes. One second, yo, sorry. Okay, so next slide. Okay, so this is just kind of a quick kind of overview of where home prices have been as well. So this was kind of the COVID push where home prices flew up, and then they've kind of dropped down a little bit. So when I last looked, home prices were around like I think the national or the average home price was around like 368,000, somewhere in that area. All right, so let's go there. So why is my camera not working? Okay, I don't know why I'm not on camera, but okay. Anyway, let's keep going. I'm done with these webinars in a while. Technical difficulties. All right. So mindset, in my opinion, is very important. So first and foremost, I want to say, like, why do you want to buy a house? Is it just because some like random guy on the internet said, hey, you should buy a house because Tim in the break room said you should buy a house? Like, why do you really want to buy a house? I think that's really important for you to understand. Is like, what are your goals as far as buying a house? And so I'll also say too, like, how is life going? Really, like, is your life stable? Like, do you have a, not that you need a girlfriend or boyfriend to have your life stable, but like, hey, if you do have a significant other, like, what do they think about buying a house? Are they, I'm in Dallas, or they're like, hey, I want to be in Dallas for the long haul? Do they want to move back to LA or move back to DC? Like, what does your significant other want to do in this situation? Like, you need to make sure you guys are all on the same page, because if you're ready to buy a home, but your significant other doesn't want to buy a home, or they want to have flexibility for the job, you need to like figure out what's going on as far as real life, right? And then she'll always say, like, where are you financially? Like, are you financially stable? Maybe you had a good year at the job. Maybe your job is not going too hot. Like, maybe they cut overtime, they put hours at your job. Maybe things aren't going on the up arrow. So you need to kind of figure out, hey, does this make sense for me to make this huge financial decision right now? And then still, like, once again, or you may have like a side hustle or something like that. Like, how is that going? You need to figure out like where things are with you financially. That's very, very, very important. All right. And so goals. So like, what is your goal with actually buying this home? Like, hey, is this going to be like a starter home? Are you building your portfolio? Like, what are you planning to do with this home? Because it's very important to make a informed decision when it comes to purchasing your first home, because it kind of helps set up your portfolio throughout the rest of your portfolio throughout basically your life, basically. So from an underwriting perspective, like, if you're looking at like the multifamily space, it's a lot easier to buy like a 4-unit property and then go down to a like a 3-unit property than it is to buy a 3-unit property and go up to a 4-unit property. So especially if you're planning like to house hack and execute on like the 4-3-2-1 thing, you need to figure out like what the game plan is, and if possible, start as high as you can. And once again, if you're house hacking, like, you can house hack with a single family property. Like, a lot of folks don't talk about that. That's what I did personally. I house hacked with a single family property when I was a youngest, probably 21-year-old, fresh out of college, right? I house hacked just renting out my room to a roommate. And it's important to know kind of what type of property you want as well, because like, I was in the Navy at the time, and so I traveled a lot. So I made sure to get like a condo, so I didn't have to worry about cutting the grass, picking up mail, really security or anything else that I would have had to potentially worry about with the house. Like, hey, what's going on with the lawn? What's going on with the basic overall security of the property? And so you kind of got to figure that out. And I want to say it's very important for you to figure it out yourself. Like, your realtor, your lender, in theory, they're smart, they know what they're doing, but they're only seeing things through their particular point of view. So only you know what's best for you. They can help you, but only you can really know what's best when it comes to your personal goals. Okay, so now we're going to talk about we're going to get into some actual stats, numbers, guidelines, probably what you came here for to see in the first place, right? So let's talk about the FHA loan. So with an FHA loan, you need basically a minimum of a 500 credit score. That's literally what the FHA loan guidelines say is, hey, as long as you have a 500 credit score, you can meet the minimum guidelines, not necessarily qualify for, but you can meet the minimum guideline for an FHA loan as long as you can put down 10% on the property. So if you got bad credit, and yes, a 500 credit score is bad credit. As long as you can put down 10%, you can meet the credit eligibility for the property. I always like to point out that you're eligible to qualify. That doesn't mean that you'll qualify. You can have like a 660 credit score and still not qualify for an FHA loan or other type of loan because you have to meet all the guidelines and there's other criteria, right? So that's the minimum credit score for an FHA loan. But you will get hammered on the interest rate, like you're going to get killed if you have a 500 credit score. But there are lenders out there that can lend all the way down to 500. Don't expect to walk into Wells Fargo or Chase or Bank of America, Rocket Mortgage, or any of like the major lenders and get a credit score or get or qualify with the 500 credit score, because lenders have something called lender overlay. So what that means is that, hey, lender X, Y, or Z cannot go below the 500 criteria, but they can set their personal qualification criteria above that level. And so as long as they do it for everybody, it's not like discriminating or anything, but pretty much every lender has some sort of guideline or overlay. Now, so what you traditionally hear about with the FHA loan is 3.5% down. That's with the 580 credit score. Once again, honestly, you're probably going to get hammered on the interest rate again. So like when you hear like folks talk about interest rates and, you know, someone's like, hey, rates last week were like 7.14% on average. That is the average interest rate. So obviously an average means there was a number lower, there was a number higher. You're going to be the number higher in the average if you got a 580 credit score, just to be honest with you, right? And so one of the big keys to an FHA loan, and one of the big selling points to an FHA loan is house hacking and buying a multi-family property. So the 3.5% down payment is whether you're buying a 1, 2, 3, or 4 unit property. So it's one of the few loan programs you can buy like a 4-unit property and only put down, well, I guess literally the only one, right? And put down 3.5% on the property. And so we'll get to a conventional loan on the next slide so you can kind of see what I'm talking about there as far as a point of comparison. Oh, big shout out to you guys on YouTube. Appreciate the likes. If you're watching the live, give it a like, or if you don't want to, don't do it either. But you should give me a thumbs up because you're getting some good information, right? And so another very important thing as far as the FHA loan is the FHA self-sufficiency test. This is something very important because I'll be honest with you, I did not even know what the FHA self-sufficiency test was until probably like a year and a half of being an actual mortgage lender. So like I was doing FHA loans. I had no idea what this FHA self-sufficiency test was. And so some lenders don't know it. There's a very, very good chance your realtor doesn't know it unless they work with multifamily property. So you need to understand what it is, right? First and foremost, because this is your financial decision you're making, right? And so what it says is that on a 3 or 4 unit property, the rents on the, your mortgage should be no more than 75% of the rent. And so just to break this down in layman terms, if you have a 4-unit property and each unit is $1,000, right? So $1,000, $1,000, $1,000, $1,000, $4,000. So your mortgage, your principal, interest, taxes, and insurance payment cannot be more than 75% of that rent number. So 75% of 4,000 is 3,000. So your principal, interest, taxes, insurance, and any HOA dues payment on a monthly payment cannot be more than $3,000. That is an FHA guideline. And so if your mortgage is $3,001, unfortunately, you cannot qualify in that situation. How you can put down more, money to lower the principal and interest payment, but that's just how the FHA self-sufficiency test works. It's a thing to basically protect the borrower. Because think about it, like if you're in a 4-unit property and you're in one of the units, let's say someone moves out, or let's say someone loses their job and they can't pay you, or let's say that you lose your job, the rent from the other 3 units should be able to sustain you. And so you'll be self-sufficient. So if you guys got questions, drop in the box. I'm going to look to see if there's any questions at the 25-minute mark. So every 25 minutes, I'll check on questions, right? The amendatory clause. This is a clause in government loans, FHA and VA. I guess I'm a realtor now too, but realtors will tell you won't really admit this thing, but they don't really like FHA loans, right? Or they may just tell you blatantly they don't like FHA loans. But one of the parts of the FHA loan is the amendatory clause. And what it says is that if the appraised value of the property comes in less than the sales price, that the seller, or excuse me, the buyer can back out of the contract and still get the earnest money back, even after what's called like the option period or like the inspection period. It basically, if somehow it came back like 1 day before closing, or really 3 days before closing, the buyer could still back out of the contract. So that gives the buyer a lot of leverage in negotiations if the sales price comes in low. So if there's two equivalent conventional offers, honestly, your FHA offer is not going to win, because realtors don't want to deal with that stuff. And also the appraisal is the appraisal, but during the appraisal, there's someone evaluating the value of the property, but they also have eyeballs too. So there's certain safety things as part of the appraisal that has to be fixed. And so realtors, I'm just being honest with you guys, realtors don't want to deal with FHA loans. The market's changing a little bit now because it's the market's kind of neutraling out a little bit more. Some may say it's even a buyer's market now, right? So you have a little bit more leeway with FHA loans. But if you try to like get a home probably in like 2021, 2020, like your FHA loan was like at the bottom of the stack, right? So that's kind of is what it is. And here are the FHA loan limits as well. I want you to pay particular attention to the loan limit for a 1-unit property. It is $472,000, right? So that's the FHA loan limit for a 1-unit property. Now let's go to our next slide. Boom, let's look at those conventional loan limits, almost $300,000 more. So there's a lot more leeway, or you can have a lot more purchasing power with a conventional loan. And so your minimum criteria for a conventional loan is 620 credit score. Your down payment is going to be between like 3 and 3.5%, depending on your scenario. But the minimum down payment for a conventional loan is 3%. You're most likely going to get your best pricing around the 680 area. And for multifamily properties, your down payment is going to be like 20+% for like a 3 or 4 unit property. Once again, see your mortgage lender for your specific scenario, but this is kind of like a high level stuff, right? The most likely scenario, I'll just say that. And so your loan limits are down here as well. So like if you're buying let's go back to the FHA slide real quick. So like if you're buying a 4-unit property with an FHA loan, you can only go all the way up to $907,000, right? You can go up to a little bit north of $1 million, or I guess maybe a lot north of $1 million for a conventional loan as well. But once again, you're looking at like 20-25% for those multi-unit properties with a conventional loan. All right, I see the questions. I'll answer those at the 25-minute mark, so in about 2 minutes, when I get to the end of these guidelines. And so high balance areas are like your LAs, your parts of DC, New York, where it's super expensive to live. Those are your high balance areas. And so you have a little bit more leeway as far as going up for loan limits. All right, and so real quick, just to recap, conventional versus FHA. FHA is more forgiving when it comes to credit wise. Conventional has a lower down payment for just a normal single family property, 3.5%. With conventional, the good thing is your mortgage insurance with a conventional loan drops off once you reach an 80% loan to value ratio. A loan to value ratio is what it sounds like. It's your loan amount divided by the value of the property. And so that value of the property can be typically it's based on the sales price, unless you get the property appraised later on in the transaction. Who has the better rates? It honestly depends on who the lender is. I'm not gonna tell you who the lender was, but I was at a lender who did not want to do FHA. So folks will tell you that FHA loans have better rates traditionally. They probably do, but I was at a lender who just didn't want to do FHA loans, and so legally they couldn't come out and be like, "Hey, I don't want to do FHA loans," right? So what they did is they jacked up their FHA loan rates through the roof. I think at that time interest rates were like 4%. I think our FHA rates were like 6%, just basically discouraging you from going FHA with us. I'll feel bad when folks try to do an FHA loan with me. I'll be like, oh, your sure rates seem a little bit high, man. And so, as I mentioned, the inspection is the appraisal. There are less things that need to be fixed or safety issues that need to be cured when it comes to an inspection. Seller perception. Just believe me on this. If there are two equivalent offers, your FHA offer, honestly, there's a 99% chance it's not going to get accepted. That just is what it is. But please understand me. I'm not discouraging anyone from using FHA loan. Like if you can't qualify for a conventional loan, once again, do the credit. Hey, go to FHA loan. Get you a realtor that can fight for you, that knows the market, etc. And put in those FHA offers. But just throwing some information out there. And once again, for multifamily purchases, you want to go with FHA. If you're asking questions on Instagram, go to YouTube. You can get your question answered there. So I got a whole bunch of things in front of me. I can't see everyone's question, unfortunately. But if you answer on YouTube, there's 100% chance I will answer it on YouTube. Your thing may get lost on IG. VA loan. So I'm just going real quickly on these because these loans probably apply to the least amount of people. If you want to go to my YouTube channel, if you want to go to my YouTube channel, I have like a playlist that has all the like very in-depth breakdowns of these loan programs that are like 15, 20, like 15, 20. I think it was like 25 minutes for FHA, right? So VA, technically there's no minimum credit score for a VA loan or USDA loan. But as I mentioned, lenders have overlays. And so most likely you're going to need around a 620 credit score. There's actually, once again, there's no loan limit for a VA loan. A lot of folks don't realize that because I see lenders talking about VA loan limits. There's literally no loan limit for a VA loan. Now, once again, lenders can put their own caps on it, but the VA does not have a loan limit. Unless you actually do already have a VA loan, then there's loan limits there. And typically they'll kind of default to the conventional loan limits. But if you're a brand new veteran, hey, there's no loan limit. Once again, 0% down. There's no mortgage insurance for a VA loan either. USDA, no loan limits. And so USDA loans are for like rural areas. And so a lot of folks hear rural and they think, hey, maybe in the boonies. Well, I live in the Dallas area. There's USDA zoned areas within like 15, 20 minutes of downtown Dallas. There's a suburb about 30 minutes north of Dallas called Frisco. There's a lot of stuff going on there. I think like the average home price there is maybe like $700,000, $600,000, something like that. There's a lot of moving and shaking going on in Frisco. There's USDA zoned property within like 10 minutes of Frisco, which it's a place people like here in Dallas. So NACA, the loan everyone loves and everyone hates as well. So yes, NACA loans, there are no credit, no down payment, no closing costs. So if you go to my bio, go to my YouTube channel, my bio, that's where you'll be able to join the live on YouTube. So for NACA, there's no credit, there's no down payment, and there's no closing costs. There literally isn't. I've not used a NACA loan. You have to be a NACA lender to use the NACA loan. NACA has like their own ecosystem, right? And so, but I know folks that have used the NACA loan. I've interviewed folks that have gone through the NACA program. And so I understand how the NACA program works from that perspective. Everyone says like, what's the catch? Why does the NACA program take so long? Well, there's a lot of red tape, yes, but think about this. They're providing you a loan when you may have credit challenges. You may not have money for the down payment. So yes, they're going to do a bunch of research on you. They're going to require a lot from you. One of the big things when it comes to NACA is the history of savings and credit responsibility, because they don't use your credit score. So what they're going to do is like look at your last 12 months of like payment history is your ability to save money the last 12 months. Like if you want to buy a home and your mortgage is going to be $3,000, they have to see that you've been able to either pay $3,000 towards your rent on a consistent basis or save $3,000 a month, like if you're like living with somebody for free. If you can't show that for 12 months, you got to start from wherever you are and get 12 months in a row. So that's why folks are like, hey, NACA takes forever, but they don't ever point out the part about them not meeting the basic like criteria when it comes to credit, when it comes to savings history or something like that. So NACA isn't perfect. No loan program is perfect. But honestly, if I was a first-time home buyer, I would give it a shot. The rates are lower. It doesn't seem all that bad. I know a guy that used the program twice, even though you can only use it once. So Renaissance 125. I got an interview with him on my YouTube channel if you want to check that out. Oh, right. Okay, so I'm going to do this live because I had to X out of the screen. So finding the perfect home price. This is how you do it. So, hey, some folks would be like, hey, I want to buy a $450,000 home, but my budget is only, but my budget is only $3,000, or they may be paying like $3,000 a month for rent. And so when folks come to me, I always ask them, like, I'm like, hey, what do you think the mortgage is on a $450,000 home? And typically they have no idea. And so meanwhile, their budget may be $3,300, but they're going to buy a $450,000 home. And I'm just making this number up. This will be very different based on where you live at. But the monthly payment may be like $4,100 or $4,200 or something like this. So my advice is always start with your budget and work your way backwards to figure out what that home price is. So I'm going to show you how to do that. I did have these screens open, but I closed them. Let me share my screen with you on Google. New share. Google. Okay, here we go. All right, so here we go. So how do you figure out the perfect home price? So let's say in this scenario, you're paying $3,300 a month for rent. So what you want to do is just go to Google and literally do this. Mortgage cal. You get to see what Google, right? You go to mortgage calculator, right? And literally this will pop up on Google. A literal mortgage calculator will pop up on Google. Make sure you guys can see my, if you guys see my slide, let me know. Oh, sorry, real quick question. I told you I would answer your questions. What are some good lenders that offer FHA? Literally every lender offers FHA. So you would have to just figure out what's a good lender for you. What do you, oh yeah, but yeah, DMV in the building. 6%. I'm not sure what that was in relation to. Sorry if I got there too late. My email is hello@housebridgeshow.com. All right, so those are the questions so far. So you go to your mortgage calculator and literally just start typing in numbers. So we're like, oh, my budget is $3,300 a month. So you want to start typing in loan amounts until you get a number that's about 60 or 70% of that number. So I'm going to type in 368,000, which just happens to be like the average home price right there. And so that comes out to a principal and interest payment of $2,558. So I'm going to write this down, $2,558. All right, so 2,558. So now what I want to do is, okay, this is a little bit less than $3,300. So now what I want to do is, I'm just going to go to Zillow.com. Folks hate Zillow, so Zillow's fine with me, right? So now I'm in Dallas, so I'm going to type in Dallas. So I'm looking for homes in Dallas, right? That are going to be around $368,000. So you may want to type in your actual zip code, but wherever you're looking to buy a home, that's where you now want to go to and start typing this information. So price range, I want to look at prices between $300,000 and $400,000. Because once again, the price range I put in there was $368,000. So now let's see what Dallas has to offer me. Okay, so we got a property there. All right, check this out. Oh, we got a new construction property. Let's check that out. That's around $365,000. Okay, this one's been on Zillow for a minute. New construction too. Is this brand new? Not a lot of new houses in Dallas. All right, let's check out these houses. So what we're going to do with these houses is now we're trying to figure out what the property taxes are on these houses, because we got a principal and interest payment now, so we need to figure out what taxes are on these properties. So we literally just go to Google right here. If you're in Dallas, you can actually go to the Dallas DCAD site to pull up the actual taxes to verify this. But you just want to go over to price and taxes, right? You need to do too much research. And so we're looking at price history. Sorry, this window in front of me. All right. And so boom, we're looking at what it's sold for, what it's sold for. Okay, boom, tax history. Wow, okay, so we got tax history. So taxes on this property are about $5,800 or about $6,000, right? So okay, we're just gauging this. So on a $400,000 home, taxes are about $6,000. Okay, let's look at this new construction property. All right, taxes. Let's find the tax on this property. So taxes are about $3,400. Those were actually higher than I thought they would be. Let's look at another new construction property because I want to show you guys something. Let's go to taxes. Okay, this is what I wanted you to see. So this is a new construction property right here. And you can see the taxes are $879. So the taxes are so low on this property because it's a brand new construction property. So that's one thing you need to pay attention to when you're looking at properties online. If the taxes seem super low, there's a reason for it. It's because the taxes are based on the value of the property on January 1st, like the year before. So the year before, this was just a dirt lot. So that's why the taxes are so low on this property. And also you may see taxes are low. There may be some sort of like veteran exemptions. There may be like over 65 exemptions. So if the taxes seem like super low, there's a reason for the taxes being super low. So that's why you want to look at a couple properties. Prices, taxes. And so on this one, so taxes are about $6,700 on this one. And so in this scenario, you would basically, I always just go with the highest number so to play itself. So you would take 6791 divided by 12. And so your taxes on a monthly basis are going to be about $565. So we want to take 565 plus 5,899. Oh, excuse me, 2589. So right now our mortgage payment is going to be about $3,154, and that is before taxes, or excuse me, before insurance. And so homeowners insurance, honestly, is kind of hard to gauge. I tell folks just to maybe add like $200 to it. You can actually have to talk to like an insurance professional in order to really figure out what that number is for your area, because insurance can vary. Sometimes there's a big swing on what it can be based on like what's been going on or what's happening in that area. So you would take that insurance now, so you would add, let's say, $150 to this, so my numbers work out fine, and you would get a monthly payment of $3,304, which kind of lines up a little bit with your budget of $3,300. So that's how I recommend finding your home price, is actually working backwards to find the home price and not just falling in love with a certain number. Because what happens when you fall in love with a certain number is you'll talk yourself into a home price that you most definitely cannot afford. You may not be able to afford, because there's a difference between what you can qualify for and what you can afford. Your lender's job is to figure out what you can qualify for. Your job is to figure out what you can afford. Because that's why folks talk about being, home ownership is so expensive. It's because they bought a home that's well out of their budget. So yeah. And so always remember, the more expensive the home is, the more everyone in the transaction gets paid. Your lender, your realtor, title companies, insurance companies, etc. So just food for thought. Do whatever you want to do with that statement, but just be aware of that, right? All right, so let's get into the money. It's very, 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 very important to understand how to read a loan estimate and compare quotes. Like where I see folks get taken advantage of in the home buying process, that they don't understand how to read quotes from lender to lender. So I'm going to show you how to do this. So here's how you read a loan estimate. So we're comparing quotes between lenders. Originally, you may see stuff like a closing cost worksheet or all these different weird formats. You can't compare quotes between lenders unless you have a loan estimate. You're not going to have a loan estimate until you're under contract. So feel free to hang out and work with whatever lender you want to. But always remember, when you're comparing quotes between lenders, unless you actually have a loan estimate, and you because with the loan estimate, that means you have they have your down payment, they have the actual purchase price, they have the most importantly, they have the interest rate for that day and time. Like if you get a closing costs worksheet from somebody like 2 months ago, like rates could be vastly different 2 months ago than they are today. So whenever you're comparing quotes, compare quotes from lenders once you're under contract. Don't worry about comparing quotes between lenders when you're off, just getting your pre-qualification letter and and running around with the lender, because you may find a home the next day, you may find a home in 2 or 3 months. And so we're going to talk about how to read these loan estimates. All right, so I want you to look at this loan estimate and let me know what you think is the most important thing on this loan estimate. You can say it in your head, you can type it into the chat, you can type it into IG. Oh, you don't see the slides on IG. You figure out what's most important for you as you look at the slide, and I'm gonna get a drink of water. Because there are a lot of numbers, and so I know it can be confusing. All right, so most folks, I think, when they're looking at like a loan estimate like this, they probably would say, hey, what's important to me is the interest rate. What's important to me is like the cash to close, how much money it's going to cost to buy the home. And that's typically how the average person compares quotes between lenders. So me, somebody that's been a lender and understands how to read quotes, the most important thing to me is the interest rate is important, but it's these columns A and B on a loan estimate. And those should be the columns that are important to you as a consumer comparing quotes as well. And I will show you why right now. All right. So the columns A and B on a loan estimate, because the loan estimate is the fees that the lender is quoting you. The only fees that your lender has control over on a loan estimate are columns A and column B. So once again, let's look at all these numbers: C, D, E, F, G, H, I, J. The lender only has control over columns A and columns B. Because these are like your origination fees right here, application fees, underwriting fees. These are basically the operational costs for a lender to fund a loan. And down here are the services you cannot shop for with that lender. And so we have like your appraisal, your credit report, your monitoring fees, and all that. So when you're like comparing quotes between lenders, you only need to compare columns A and B from the lender. When you're looking at columns C and D, E, F, and G, those do not matter one iota. And sometimes, honestly, what like unsavory lenders will do, they'll artificially like deflate the numbers in columns C and D to make their number look better, because they know typically you're going to just look at this cash to close number over here, which is the grand total number. And so they may make these columns C, E, F, and G look artificially lower in order to win your business, because you'll be none the wiser, right? And so you're just comparing these two numbers when looking at quotes from lenders. And also, whenever you're looking at quotes between lenders, the interest rates have to be the same. Like you cannot compare a quote between lender A, B, and C if the interest rates are not the same, because there's no way to compare these origination fees unless your interest rates are exactly the same. And I'll show you why in about 4 more slides. But let's keep going. So column C. Get out of here. So column C. These are the title fees. And so the thing with the title fees is the title fees are going to be the title fees. So whether a lender quotes you title fees are going to be $3,000, $4,000, or $2,000. They don't have the title fees at the time that they're providing you the quote in the first place. So it's just a guess. And so one lender may guess high, one lender may guess low, but the fees are going to be whatever the fees are. The lender does not control the title fees. The title company controls the title fees. So that's why you don't really need to factor them in when you're comparing quotes, because they will be what they are no matter who the lender is. So if you decide to go, so let's say lender A says title fees are going to be $3,000 and lender B says they're going to be $3,500. Well, if you go with lender A because they said the title fees were going to be lower, and they come back from the title company and they are $3,500, they're going to be $3,500. So they get updated after the lender reaches out to the title company. They don't have them at the time of the estimate. So let's go to the next part of this loan estimate. So taxes, insurance. Your taxes are going to be the taxes, right? You know, Dallas County, Dallas City, or wherever you're at, that place determines the property taxes for your unit. The lender can typically pull the taxes. Hopefully, most lenders will provide you an actual accurate estimate of the taxes. But once again, an unsavory lender can just make up a low number for the taxes, right? Or maybe you looked at well, maybe they pulled the taxes and it was like a new construction property, like we saw in the example just now. And so they're artificially low taxes in there. But a more seasoned lender may say, hey, I know these are new construction taxes, so they may put in like what's going to be a higher number to provide you a more accurate quote. But you're like, hey, this lender said taxes are only going to be $800 a year. The other lender saying they're going to be $4,000 a year. I'm gonna go with the lender that says taxes are going to be $800 a year. Once again, the taxes are going to be what the taxes are, no matter what the lender says. And also, your insurance, right? Like you probably have not reached out to an insurance company yet. So how in the world would the lender know what the insurance is going to, your homeowner's insurance is going to be, right? They're just estimating that. And so once again, some lenders may estimate high, some lenders may estimate low. All right. And so that's why you can kind of ignore these columns as well. And when I say ignore the columns, look at them just so you have a good idea of what the cash to close will be. Like if all the lenders have a cash to close that's probably within like $1,000 or $2,000 of each other, that's probably a good gauge of what the cash to close is going to be. Oh, so cash to close, that's where they'll add everything up. So like another thing is, so the lender I was at, like for whatever reason, they would not put earnest money on the loan estimate. I don't know why. And so they would always freak borrowers out. So like in this example, let's say this negative $10,000 and like earnest money wasn't going to be there. This would show like maybe $26,000 cash to close. And sometimes folks would freak out. They'd be like, hey, well, your quote says $26,000. This other quote says $16,000. Their quote is lower. And I'm like, no, the earnest money is the earnest money. Earnest money is like a good faith gesture the buyer makes to the seller once they're under contract. It depends on your market negotiation, but it'll probably be like 1% of the sales price. But the earnest money it goes towards the closing costs and the down payment. So whether the lender puts earnest money on there or not, it's not lost money. It comes out of the down payment if you close on the property. Okay, cool. So let me get to questions. Can this be done under an LLC? Also, like if your traditional lenders aren't going to do like the LLC stuff. I mean, some lenders do with LLCs, but you're not going to go to like a Chase or honestly most brokers and like you're buying your first home in an LLC. I honestly I don't know why anyone would do that. To be honest with you, maybe you're looking at like buying some investment properties and stuff like that. You can maybe look at like a DS debt service coverage ratio loan possibly, but there's no need to put properties in LLCs. Like that's all the rage from people on IG talking about that, but there's really no reason to do that. So are there any creative financing options you can recommend for the 20% down payment? So you don't have to put down 20%. So you can just do an FHA loan, 3.5%, conventional loan, 3%, USDA 0%, VA if you're a veteran or unfortunately married to a deceased veteran, 0%. So you don't need to do honestly anything creative in order to put down 20%. So lenders don't care about debt to income ratio. No, that is very important. That's one of the big three things lenders care about. They care about your credit, they care about your funds for the down payment, and they care about your income in relation to your debts, your DCI. Yes, they care about that very, very, very much. One of the big three components of qualifying for a loan. All right, so let's talk about understanding how interest rates work. So, like another thing I see is like, or you probably see is like folks talking about what rates are, or sometimes like a lender will, folks will call you up all the time. It's like, hey, what are your rates? I get so annoyed by that question. I can say it to you, but I get so annoyed when people ask me that question, just because I'm like, that's such one, it's a waste of my time and your time, because I know absolutely nothing about you in order to even provide you a rate. So like calling up a lender and asking them like what your rates are is a waste of everyone's time, just to be 100% honest with you. Because unless the lender knows your credit score, they know the loan amount, they know the down payment, they know like what loan you're using, they can't really generally quote you a rate over the phone. So any lender that's busy will just tell you, hey, to apply online, or quote you some generic rate over the phone, which doesn't really help you at all. And honestly, for most lenders, you can just go on their website and type in your specific criteria and it'll pull up a rate. So don't waste a lender's time and call them asking them what the rates are when they're on their website. So save a lender's time. And so like rates you see online are not your rates. You can tell this is a very old chart because rates are 3% in this chart. But so like when you're looking at a chart online, you'll see like, hey, rates are 3%, APR 3.103. But that is most likely not your scenario, because whenever you see rates online, there's very specific criteria. And typically it is this. It is a $250,000 loan amount. It is a 20% down payment and a 20% down payment and a 740 credit score. So unless you got a 740 credit score, which is perfect credit from a lending perspective, and are putting down 20%, whatever rate you see online is not your rate, most likely. All right, so quick question. Should we save 10K for a down payment and 17K for closing costs, which would be $27,000? I don't know. I'm not sure what your scenario is. I would need more detail on that. Any advice on the 203K loan? Find a lender that's versed in the 203K loan program, a lender that understands the rehab process as well and can look at a property that may be the ugliest home or second to ugliest home in a nice neighborhood and can tell you what that property may be worth after renovations. Yes, I think that's kind of my advice from a high level when it comes to that topic. So hopefully that answered your question. Whoever was asking about the 27K, I need some more details on that, but I'll answer that question maybe at the end if it's super specific to you. So what criteria does a lender use? We need to know, once again, your number of years, credit, sales price. Oh, what I just said, right? What do you know? And so like some lenders, so will actually, if you actually click on the actual numbers, so if you like actually click on the rates, so if you click on this yellow thing right here, some lenders will actually show you like what go a little bit more in depth on the criteria. So in this situation, like, okay, we're actually using a 0.5 point to buy down the rate. We're estimating closing costs. Don't ever use the closing cost estimate from an online lender, because they have no idea what city or state you're in for the most part, to my understanding. So it's just like a general number based on like the entire US. You want to get that number from a mortgage lender, not your realtor, a mortgage lender. Once again, realtors are great. I'm a realtor, but realtors do not understand finance, and why would they? They do not do it on a day-to-day basis. But a lot of lenders or realtors like to stick their nose into financing when they don't know what they're talking about. All right, so next slide. Okay, so right here is a rate chart. And this is very important for you to look at, because a lot of times you will see folks always say a lender can give you any rate that you want to hear. They can literally give you any rate that you want to hear. And I'm about to show you why. If you're on YouTube, feel free to hit the, if you're enjoying the content and you're getting value out of this, hit the like button. It helps push the video out to more people. It boosts my morale and it makes me create more videos. So there you go right there. Appreciate you guys watching though. All right, so So like if you call me up and you're like, hey, what are your rates? And like today's rate is the number closest to zero may be a 4.375 because this is the smallest number without any cost or buy down right here. So I may tell you my rates are 4.375, but I could also say my rates are 3.500. That's accurate as well. The only difference between the two rates is in one scenario, you're getting back about $148. In the other scenario, you're paying $2,900 to buy down the rate, which is why I always say it's not a good question to ask a lender over the phone what their rates are, because they can say 4.375, they can say 3.375, and they're both accurate. But you, the average consumer, typically does not know to ask about, hey, are there points attached to this loan? Are there any buy downs, etc. And so, if you want to get a quote from lender, just fill it out. Just fill out an application, honestly, on their website, or go to their website and type in the information so you can kind of figure out what rate fits best for you. And typically, it'll show you like if there are any points attached to the loan. But if anyone's quoting you a quote over the phone, they're just going to give you this super low rate and not quote you the points. So that's just is what that is what it is there. And so this is also why I said earlier in the presentation, like 4 slides ago, you need to know, excuse me, you need to have the exact same interest rate if you're comparing quotes between lenders, because if you're comparing a quote from one lender and they've quoted you like a 4.125, their costs, you may be like, oh, it's going to cost me an extra $1,000 to buy down the rate. But if another lender's quoting you a quote at 3.5, right, they're going to be quoting you like $2,900 to buy down the rate. But you can't accurately compare quotes because you don't know if the lender is at the 3.35, if they're what their points would be at 4.125. Hopefully that makes sense, because what I'm trying to say is different lenders have different costs to buy down rates. So one lender is 3.350. It may cost them $1,700. It may be $3,500. It may be various different numbers. So you need to have that lender provide you the exact quotes. You can compare the exact buy downs. All right. Hopefully that made sense. All right. So lender realtor relationship. I always like to point this out because I find out a lot of stuff in the industry, which seems kind of wild to me. But so your lender realtor relationship. So a lot of times, like your lender or your realtor is going to refer you a lender, and 90% of the time it's going to be because they work with that lender very well. They trust the lender. They've closed deals with the lender, and they're very comfortable. Or somebody just told them to use this lender because their brokers told them to use it. Right? There are various reasons that lenders, their realtors, refer certain people to you. But what you'll see every now and then is a realtor that is a little bit too enthusiastic about referring a lender to you. Like they're pushing their lender a little too hard. Because honestly, it shouldn't matter that much to that realtor what lender you use. And I've seen this a lot. And I would always wonder, I was like, man, why is this realtor pushing this lender so hard? Like they'll take the client to the lender. They'll do all this stuff. And it's like, why are they pushing so hard? And then I found out something called a marketing services agreement. So what a marketing service agreement is, it allows a lender to basically pay a realtor for marketing. And so a marketing service agreement isn't inherently bad. A lot of times realtors and lenders that have great working relationships just have these relationships in place in order to, once again, pay for marketing. So it's nothing inherently bad about that. But if you're in a situation where your realtor is pushing a lender a little bit too hard, just be aware that there may be some sort of like financial reciprocity going on there. That's why they're pushing that lender on you a little bit too hard. Because honestly, they should not even care. And I think technically a realtor is supposed to give you 3 referrals anyways, but rarely does that ever happen. So I just talked about the marketing service agreement. Once again, it's not a bad thing. Like title companies and builders have them. Lenders and mortgage companies have them. It's not a bad thing, but just be aware of the realtor that's pushing their lender a little bit too hard. There may be some kind of like financial reciprocity going on, which is why they're doing that for you. And so once again, realtors are free. Like you should never, you don't have to use a realtor. Technically, you have to use a realtor. I'll get into that why, but you don't have to look at houses with a realtor. It doesn't make much sense for you not to do it because a couple of things. One, the realtor is essentially, for the most part, free to you as a buyer. Like 98.5% of the time, 99% of the times, the seller will pay the commission to your realtor, right? And so here's what happens when maybe you're like half stepping into the home buyer process. So maybe, you and your spouse or you and your fiance, you and your friend are just walking around on Sundays going to open house. You're like, I'm not that seriously committed to buying a home, but I just want to kind of look at open houses. And that's honestly what I did as when I was first looking at homes. That's what me and my wife did. We looked at homes for about 3 months on our own. But here's the thing: in order to make an offer, a realtor has to be involved in the transaction. So what happened is the listing agent will be like, "Oh yeah, I can help you out. I can write up this contract for you." But so so the listing agent can kind of write up the contract for you, but you get into a situation, it's like a dual agency, and so the listing agent technically will have somebody else help you negotiate the sales price, and they'll represent the buyer. But yeah, to me, it gets a little cloudy in my opinion. We have like the same kind of brokerage, the same people negotiating a deal between the buyer and the seller. Excuse me. It gets a little cloudy. We have people in the same brokerage negotiating a deal, in my opinion, between a listing they already have. Once again, there's nothing wrong with that, but there's a little bit of gray area there. You might as well kind of walk into the situation with your own representation. So if you're like, hey, I want to make an offer, I always recommend just getting your own realtor and making an offer with your realtor. So once again, there's no loss to you because the commission is either going to the realtor you represent or the person that's listing the home gets the commission. There's not a situation where like the commission somehow comes out of the sales price or something like that, or you get to buy the home for like 3% less. The commission is being paid one way or nothing. And also, you may be able to, if you already found the home, you may be able to like negotiate some sort of like commission, for lack of a better term, kickback from the realtor if you already found the home yourself. So there you go. And so why I say the seller almost always pays commission. So if you ever look at like a buyer's agreement between a realtor and the buyer, technically it says on there that, hey, if the seller doesn't pay the commission, that you have to pay the commission. I don't know why the seller wouldn't pay it, but it does say that in the contract that if for whatever reason the seller doesn't pay the commission, I don't know why they wouldn't, but you are liable for it. But I've not seen a situation in my experience where one of my buyers had to pay the commission, but that's in the contract. All right. I think we got about, how many slides we have left, y'all? Okay, we got 20 slides left. All right. And once again, if you're on Zoom, this whole replay will be on YouTube. It's being recorded right now, so you can check that out if you got to go to bed. I don't know what coast you guys are on. Okay, so new construction properties. So I always want to point this out as well, because I like to just put everything out there in full disclosure of what's going on. So home buyers, home builders, they typically have like crazy rebates. Because think about it, like a home buyer buys like a plot of land in the middle of nowhere. They put some homes on it. Now this home or this plot of land is worth $600,000, and they may have paid, I don't know, $50,000 for the lot. So there's typically a lot of leeway that the new home builder has when it comes to home prices. And so a lot of times this is my opinion of what happens. I'm not a home builder, but my opinion is like, they're like, hey, we want to sell this home for $400,000, right? So what can we do to make the best situation for us? So we want to sell it for $400. Let's list the home for $415,000. And then what we'll do is we'll give the buyer a $10,000 rebate towards their closing costs if they use our preferred lender and they use our preferred title company. and so they end up kind of strong arming a lot of times, or sometimes into using their own realtor, their own lender, their own lender and title company in order to get these great rebates. And sometimes the rebates aren't as great as you think. Sometimes they jack up the fees and do all this other stuff in order to provide you the rebate to get you to use their in-house stuff. And also they'll bake in fees for like for realtors, right? So typically, a realtor may get like 3% commission on your home. But you can see, so I just pulled these off the internet right here in Texas. You can see this Meritage home flyer right here. So they're like, hey, if you bring them to our community and show them our houses, we'll double your commission. This one, there's like, hey, there's a realtor bonus event. So you can see this old slide 2020, and you can't really see it here, but there's like in this particular neighborhood, there is a $5,000 bonus for a realtor if they sell this property right here. On top of the normal commission, we got a guy or gal handing out dollars. And I'll point this out to say that there's probably like a 1,000% chance if you go into this neighborhood, your realtor is going to show you this property right here, right? Because hey, they're going to get a bonus. They may disclose it to you, they may not. But I always say, if you're like, why are you so enthusiastic about certain things that seem to not matter a lot to you? It may be because there's money involved. Once again, there's nothing wrong with the fees, commission, and all that. But I would just say, hey, just know what's going on, and be aware. All right. So once again, do you need a realtor? No, you don't need a realtor in order to buy homes. You need a realtor to make an offer. You'll end up using the listing agent as your realtor, which may not be the best situation for you. And same thing with new construction. So I'll tell you what happened with my new construction home. Like I said, my wife and I have been looking for homes for like 3 or so months. Just on our own. I just sold a property in Dallas. So I had a realtor. Who we were planning to look for when we got more serious into the home buying process. And so what happened is we kind of found the property honestly on our own, but I still called the realtor because I was like, hey, we found a home. I guess you want to get a free commission by putting your name in the contract. And that worked out great for me because this is literally like the first 2 months I was in the mortgage business. And so I ended up using my own company for the loan, and they royally screwed up. They royally screwed up my loan. And so luckily I had like a realtor representing me. And so he was able to kind of smooth things out, land the plane for me, get a better lender in there. And we closed this is actually the house I'm in right now. We ended up closing like 2 or so weeks late on the property, but luckily I had a realtor that was representing my best interest. So he was able to smooth things over with the builder. I didn't lose my earnest money, which was a couple $1,000s, and we were still able to close on the property because he was able to reassure the builder that we were going to make good based on the promises from his lender and everything else he had going on. So always use a realtor. There's literally no negative aspect of you using it. Well, I'm sure there could be a negative aspect, but it's not in the top 10 things. All right, so questions. What are the top qualifications besides credit score that lenders use to offer a mortgage? So we'll get into that in about 10 or so slides, but I'll just tell you what they are. Your lender literally looks at only 3 things when it comes to buying a home. So I know folks will tell you there's a lot of stuff going on. Lenders are doing all sorts of bogus stuff. A lender only evaluates your debt to income ratio, which is your income in relation to your debts, just what it sounds like. They look at your credit score, and they look at how much money you have in order to cover the closing costs. Those are literally the only 3 things that your lender looks at. And so that's the criteria that your lender looks at. Right, what we got here. What is the best thing to do when you have a credit? We have the credit, but no money for a down payment and closing costs other than going through the NACA program. So the best thing to do in that scenario is to do an honest self-assessment. It's like, hey, why do I have no money? You need to honestly ask yourself, like, hey, why do I have no money to buy this home? And would me buying a home, like would I automatically have money or the ability to now save and make my mortgage payment? So to me, honestly, that's the first thing I would do is analyze why I don't have the money to buy the home in the first place. So assuming, who knows what the answer is to that question is, but let's assume there's a good answer to that question. Now you can look at various down payment assistance programs. Like I said, you mentioned there's NACA. There's a USDA loan, which is, you go to like if you type in USDA, cry loan areas. Yeah, type in USDA loan areas, and it'll show you which areas are zoned for USDA lending. A lot of times they're a lot closer to major cities than you may think, but that's a 0% option down, or you can join the military, and you can use the VA loan. But honestly, I would do a honest self-assessment and say, hey, why do I not have the money for this down payment? Like, what is the actual reason that I don't have the money? And then what would change after I buy a home, assuming you do use one of those programs that may be 0% down. And if you go to my YouTube page, I have a video called, if you go to just type in USDA loan on my page. There's a playlist for 2023 loan guidelines. It'll be under that playlist. That's what I was trying to think of. So what's a 15-year versus a 30-year mortgage? The benefit. So in my humble opinion, really the only reason you should maybe use a 30-year loan on every single property except for maybe your dream home. Like, I particularly would lean towards like a 15-year on my dream home, because I always say you have less buying power with a 15-year mortgage if you want to keep the same mortgage payment. Like, and so, excuse me, my mouth is dry. And so you have less buying power if you want to keep the same mortgage payment with a 15-year loan. But I always say, like, hey, would you rather have like a smaller home, like maybe 500 square feet, or maybe one less bedroom, or have another 15 years left on your mortgage? So when my wife and I buy our forever home, I'm going to try to convince her to do a 15-year mortgage. Your rates are going to be better on a 15-year mortgage. You're going to pay a lot less interest, et cetera. So those are the difference between a 15 and a 30-year mortgage. And so this is my kind of conspiracy theory. Like, why is the 15-year or 30-year mortgage standard? Like, to me, it's because it lets you purchase more property, it lets you purchase more home. That's the only reason I can think of. I saw there's some rumblings that folks are looking at like a 40-year mortgage, because that'll let people buy, get into more debt and buy more homes. It's all good from everyone's perspective. I mean, the realtors makes more, lenders make more. It's all good, but just be aware. Just be aware budget-wise of how much debt you're getting into when you're purchasing a home. So I'm kind of slowing down here. We're like 70, 80 minutes in. All right, so big banks versus brokers or boutique lenders. So when I say big banks, this could really say direct lenders. So I'm talking about like your Chase, your Wells Fargo, even Rocket Mortgage, folks that are bringing money to the table. So the difference between a big bank and a broker is the bank has the money, and a broker is basically a broker or a middleman. They're finding different loan programs and different lenders that may work best for your specific scenario. And so that's kind of the difference between a broker and a big bank. So like if you go to Chase has their own guidelines. If you go to a broker, they can shop you to like 50, maybe 50, 60 different brokers and figure out what criteria works best for you. And so that's good if you have maybe like credit challenges. You're like, hey, I'm looking for a loan program that's 0% down. I'm looking for I have a 520 credit score and I want to get an FHA loan. The broker can kind of find lenders that may have guidelines that meet that criteria for you. And so that's where like a broker makes. So if you have like maybe a more challenging credit profile. So what about interest rates? It depends. Like brokers will always say, oh, we got the cheapest rates and all this other nonsense. Not necessarily. I've seen in my career as a mortgage lender, because I see a lot of quotes and I show folks how to compare quotes. I see the worst quotes. I've seen the worst quotes in my entire life from mortgage brokers, because mortgage brokers are the middleman. They tack their little fees and stuff on top of the loan in order to get their cut. And so think about that. Like the bank is just like, hey, this is our loan. This is what it is. The broker is taking a lender's criteria, putting their fee on top of it, and then giving it to you. So just just food for thought there. Brokers don't necessarily have the better rates, even though they will like to proclaim they do. Once again, programs, a broker is going to have more options for you. Oversight, I think this is very important. So let's talk about like Wells Fargo, the bank everyone hates, right? They're in the news a lot because they're Wells Fargo. They're a big bank, they're a big name. They do some unsavory stuff too. But I always like to point out is that please believe that Wells Fargo is not the only lender on the planet that is doing like bad things or unsavory things. If 10% of people do bad things, or 10% of brokers do bad things, 10% of big banks do bad things. But brokers have less oversight, because if somebody, if you get hustled at Wells Fargo and you call your local news station, they may do a story, you may get on CNN or Fox, whatever. I'm not gonna say nothing about that. Whatever channel you watch, right? Then it may your story may get on like that channel. But if you call like if you call your news station and you're like, hey, Jim's local brokerage screwed me over, blah blah blah. That may be a local news story that may be on the the Friday night news. That's not making national news. Like, you're not going to be on CNN or CNBC or Fox News. That's not making national airways, right? And so you hear about Wells Fargo, you hear about big banks because they're big names that make the news. But please believe there are a lot of small lenders doing bad things as well, because they don't have the oversight that these big banks have. So I just like to point that out, because folks may think that brokers are this great thing, but they hustle people honestly worse than the banks. So I've seen some horrible quotes. So on time closing, brokers will say, "Oh, we can do it faster, we can do it quicker," right? I was at a big bank and I closed plenty of loans in 14 days. If you need like a really quick close, like a 10-day close or something like that, you may want to lean towards a broker, because honestly, they have less oversight. If we go to this less oversight thing, they can do things to push the loan along a little bit quicker. That when your big banks may have to actually stick to the guidelines. So I'll just leave it at that. No oversight is a good and a bad thing, right? And once again, you must shop for rates. We saw the rate chart early in this presentation. Lenders can tell you anything you want to hear. So the only way to know if you got a good quote is to actually compare the quotes between the actual lenders, right? So you got to shop rates. You got to shop rates. You got to shop rates. And so you just think about anything. Like, you're not getting the lender's best offer, right? Like, the first quote the lender gives you is not going to be like the dirt cheap bottom barrel number, because that would make no sense, because they would have no margin. Like, they're a business. So what happens is, if you have like two quotes between lenders, you'll be able to see that all of a sudden, the lender you may like is able to kind of like buy down the rates, buy down the fees, or go a little bit lower, because they have another quote to compare it to, because they'd rather get 80% of the expected profit than like 0% of the expected profit, or 100% of nothing. So a lot of times lenders will match rates, and it's important to do that even if you like the lender. Like, I would tell folks, like, hey, I would tell my friends this, like, hey, if you want to go with me as a lender, that's dope, I appreciate you, but get a quote from another lender, because I cannot go any lower than the fees I present you unless I have a quote from another lender that I can match, because we're not going to compete against ourselves. Like, if I'm telling you the best rate we can give you is like a 4.0000 with no buy down, that is the best I can offer you. But if another lender presents you like a 3.875 with no buy down, that's when I can talk to upper management, and I can talk about, potentially buying down the rate, lowering the rate in order to match the fee. So make sure you are getting quotes from lenders. All right, see what questions we got. General question. Oh, before I answer questions, if you're on the live and you are getting value, feel free to hit the like button. It boosts my morale. I'll be honest with that, and it pushes out the video to more people. So give it a thumbs up. I'd appreciate that. General question: if a lender approves you for a loan of $250, you don't have to use that. That is correct. You do not have to use all of the loan amount. Even better, like, if you get approved for $250 and you're out shopping and you find a house that is $235,000, what you should do is go back to the lender and say, hey, now write me a pre-approval letter for $235,000, because you don't want the seller to see like what you're qualified for to the max, especially if you're putting in an offer that may be less. So let's say like that home is on the market for $235, but you want to offer $225, right? So you want to get the pre-approval letter down to like 225 so that the lender or the seller does not know the max that you're qualified for. Because of that, if you're offering $10,000 on the asking price and they look at the pre-approval and like, oh, this person is can qualify for $30,000 more, they're probably going to negotiate a little bit harder when it comes to that. They negotiate a little bit harder when it comes to that price. All right. Do you generally suggest people try to lean towards the 15-year? So what are your thoughts on inventory homes? So are you saying, like, if you're saying like the homes that are already built at new builders, I'm fine with them. Like I'm in an inventory home right now. So yeah, they're fine. It allows you to see the property, see what's going on. So if that's what you're asking, that's fine. If you're asking what the actual inventory of homes are in the US, I think I think technically we're still in the seller's market because we're not at like 6 months inventory. That's what the question is. I'm not 100% sure. Do you suggest people lean towards a 15-year loan? So I don't tell folks to go either way. My thing is whatever works for your budget and your specific criteria. Like I said, I personally would lean towards a 15-year mortgage if it was my forever home, because I'd rather my mortgage be paid off 15 years earlier than in 15 years and 30 years. But if you're worried about cash flow, you can get like a 30-year mortgage and pay it off at a 15-year pace. I mean, that's an option for you as well. So that's my thoughts on that. All right. Oh, so okay, I still have this on the slide. Okay, I guess it's on the slide. If you want a free rate comparison tool, apparently I need to send that to you. Oops, it's in the slide. I gotta honor it. All right, we're almost home here. Interviewing your realtor, like you got to ask your realtor questions, like because someone was like, hey, I like Dave. He was a great lender. He was a great realtor for me. That doesn't mean they're going to be a great realtor for you, because maybe your friend is super rich, right? And they're looking at $1 million homes, right? And maybe you're have a more economical W-2. Like let's say maybe you make like $60,000 a year. Well, maybe if the realtor they're looking for only like maneuvers in the $1 million price range, and they're working with you due to a favor, you may not get like the love or the attention, because they're like, oh, $250,000 home, $300,000 home. You're not going to get as much attention as you would if you're one of their $1 million buyers. So you need to make sure they're the right realtor for you. So some question you may want to ask is, how long have you been in the business? There's no right or wrong answer. So that is just a question for you to know. Maybe you want a more seasoned realtor. Maybe you want a new realtor that's like hungry, looking to get business, right? Are you part of a team? I think that's important as well, because especially because most realtors are part-time. And so like if they're at their job between 9 to 5, and you want to look at a home between 9 to 5, like who's going to be helping, who can help you show the home. So if they're part of a team, they have other realtors that may be able to help you while they're at work. Like I said, what price range do you work in? How many closings per month? Because you can say it costs, I'll say in the state of Texas, it costs like $400 to get your realtor's license. So anyone can be a realtor, right? But you want to know how many units they're closing per month, because they may help you know like their area, their level of expertise. Once again, there's no right or wrong answer to here, but there's a difference between somebody that may be I'll just say it helps you know their area of expertise. Somebody that's maybe closing like 4 or 5 homes a month. That is a super high number of homes, by the way, per month. They may be a little bit more tapped into the market. So, and also, what areas do you cover? Because realtors will tell you, like, I cover anywhere I can drive, they can cover, right? Which is great, right? But let's say maybe you're like, hey, I'm in Dallas and I want a home in like the State Thomas neighborhood. I want this particular area of Dallas where it's one of the few places where it's actually walkable. There's like cobblestones and all that down there. I want to live in that neighborhood. So maybe you want to get like a neighborhood specialist if you're only looking in one specific neighborhood. That's kind of like an important, that may be an important question for you to ask. But what's important to you, may not be important to you. All right. Got a question. What is the name of the loan where you don't do a credit check or down payment? You just simply take over the previous owner's payment. So I think you're talking about an assumable mortgage. Maybe what you're referring to. Yeah. So I got a video on that on my YouTube channel. All right. So next slide. If that wasn't what you're asking, I'll follow up with you. Okay, go to the next slide. Okay. We're interviewing your lender. Once again, how long have you been in the biz? Once again, I would say there's no wrong answer there. It just helps you know your person's area of expertise. What loan programs do you specialize in? In 5 years in the mortgage industry, I have never done a single USDA loan. So if you were coming to me to do a USDA loan, I'm not going to tell you no, but I probably don't know what I'm doing. And so everything may work out well for me because I would actually look stuff up and I would ask questions. But like complicated loans or loans that a lot of folks don't do, like VA or USDA loans, you may want to go to somebody that specializes in those loans. Because here's the thing that lenders don't typically tell you. The stack of guidelines is thick. No lender knows all the guidelines. A lot of times you find out about stuff because something got messed up. And a lot of times it's transparent to you as a buyer. It's like something got messed up and you're like, oh crap, I didn't know that. And things get worked out. But there's a lot of chaos that goes on behind the scenes that you may not be aware of. And so but you don't want the mistake to be you may not want the mistake to be at your cost, right? So you may want to ask them what loan programs they specialize in. Ask them what hours. Like some lenders, some very seasoned lenders are just like, hey, I've grinded my first 10 years. I've built a business to where I will not answer the phone after 5 p.m. I will not answer the phone on Saturday or Sunday. And hey, they're upfront about that. And so if you have questions on Saturdays and Sundays, if you think you will, they're probably not the lender for you. Because probably you're going to be shopping for home on Saturday and Sunday. So that's just something to balance. It's like, hey, make sure you know what their hours are. What the turn times are, aka how quickly they can actually close on the loan. That's super important because they could be the best lender in the world, but if they can only close loans in 35 days, in your market, the average time to close is 24 days, you may have a little bit trouble getting your offer accepted or actually closing on the loan once you get the offer accepted. Because yeah, they can't close on time, that doesn't work. And that's a lot of times some of the like the down payment assistance programs, they'll have like longer run times just because there's other layers to the loan. So like if you're using down payment assistance, make sure you know like the turn time specifically for like that any down payment assistance programs you may have. And also, do they match quotes? I've never seen a lender say no, but who knows what they'll say. All right, we're almost I think we got about 10 slides left. We're finally into the mortgage process. What happens there during the mortgage process? We're going to find out what your lender does or doesn't care about. Okay, someone to check out the video. Yeah. So question, do you work with or mentor viewers directly? Yes. So I'm a realtor. So yeah, 100%. I will help you. There's actually a link in my bio to schedule a call, depending on where you are. It's free, but depending where you are, depends on how long the call is going to be. So if you're out of town, the call is a little bit shorter. If you're local in Dallas, you can talk to me as long as you want to. All right, so let's talk about the mortgage process. But yes, I'm a realtor, so yeah, definitely I can help you with your home buying needs, no matter what state you are in. I see my wife is checking me out. I see you. All right. So you're buying a home. Boom. So what did your lender look for? During the initial consultation, your lender will look at your credit, your debt to income ratio, and funds for the down payment. Those are the big 3 things, the only 3 things that your lender evaluates. Every single thing you can think of stems off or branches off of one of these 3 items. So let's get into it. Let's talk about credit. So we always see like this, you may see like this FICO score chart, but I'm going to break it down to you as far as numbers wise, right? So payment history, Your FICO score is 850 points. 300 of these points are free. So when we talk about the number of points you can manipulate, we're talking about 550 points. So payment history is 35 points or 192.5 points. Amounts owed to utilization is 30% or 165 points. New credit, which are inquiries, is 10%. 55 points. Length of credit history is 82.5 points, 15%. And credit mix is 55 points again. So that's kind of how your credit score is broken down. And so what can impact your score? Your ability to pay your bills on time has the biggest impact on your credit, positive or negative. And now your utilization, like how much, basically how maxed out your credit cards are or aren't. So the two quickest ways to fix your credit are to pay your bills on time or lower your utilization, right? And so typically, like, you may look at like your banking app or Credit Card when they get a bad reputation as far as your credit score, right? I say they're not wrong. They're just a different score model than your lender uses. Those things use a Vantage 3 score model. Your lender uses a FICO score model, a FICO score 2, 4, and 5, which is Experian 2, TransUnion 4, and Experian 5. Experian 5, Equifax 2, TransUnion 4. Yeah, those are the scores that your mortgage lender uses. In order to get that scores, you have to go to like I want to say myfico.com. You typically have to pay for that, or you can just go to your mortgage lender and have them pull your credit. Don't be scared to get your credit pulled, especially if you don't know where you stand. An inquiry is not a big deal. Folks that do credit repair make inquiries out to seem like there's a big deal because they're super easy to remove, and it looks like they're doing stuff for you. But don't ever pay anybody to remove an inquiry. I actually just dropped on Thursday. I'm actually dropping a video. It'll show you how to remove inquiries for free. So yeah, there you go. And if you want to get a copy of your credit report, you just go to annualcreditreport.com. It won't show you your credit score because they don't know what you're using the credit for, but it'll show you everything that's on your credit report. And so, for instance, like if you're looking at your banking app and you're like, hey, is this 740 accurate? I hear that, these scores are bogus. If you go to annualcreditreport.com and you see that there's no derogatory or negative events on any of your credit reports for the major three bureaus, Equifax, TransUnion, or Experian, then your score it probably is close to 740. Now, if you got a 740 per the banking app and you go to these annualcreditreport.com and you see like, oh, there's derogatory events, late payments, that 740 probably is not accurate. That's kind of my close there. Once again, you can just talk to a lender, they'll pull your credit for free. It may dink your credit like 4 points. Like, it's not a big deal. Don't be scared to get your credit pulled, especially if you don't know where you stand, because you might as well find out where your credit is now than 3 months from now when you're finally ready to buy a home and now you don't have time to do anything to maybe fix or improve your credit. All right, DTI or debt to income ratio. So that is your monthly finance debts plus your future mortgage payment divided by your income before taxes. And so depending on the loan program, your DTI can be anywhere between like 49.999%, 43%, or 33%, depending on the loan program you're using. But talk to your lender for the exact thing. It's if you're just a straight W-2 employee, you're like, hey, I work at I'm a manager at Target, I make $60,000 a year. And that's my base salary. You can just take 60,000 divided by 12, and your income is $5,000. We have any other pay where it's like, hey, we're talking overtime, we're talking commission, we're talking bonuses. You typically need a 2-year history of those, and it's going to be an average. Have a lender figure that out for you. Don't try to calculate that on your own. If you're self-employed, you 100% need to have a lender calculate your income for you, because you have somebody doing your taxes. They're trying to write off everything under the sun. But the thing about that is your lender can only use the taxable income for the most part. And so I've seen folks that make like $120,000 not be able to qualify because the CPA write off everything. So they only make like $20,000 on paper. So just communicate with your lender and have them work out your debt to income ratio. All right. So what are we? Okay. So that's the credit question. We're still on credit. So what do you do if you receive a new collection on your credit report as you are about to close on a house. Credit score dropped 18 points. I paid for the collection, but they were not able to delete it. Should I tell my LL what is your... So yeah, I would recommend keeping no secrets from anybody. Here's the thing, your lender, they do a soft pull of your credit before you close on the home. So what is a soft pull? It's the same thing as a hard pull, except for it's not a credit hit because they're not asking you permission to do it. But they're looking at your credit report to see if you're taking on any new debt during that time frame. So if you paid the collection, hopefully you at least got some paperwork from the what do you call the thing, the collection company, saying that, hey, the debt is satisfied. But yes, please communicate that with your lender, because you don't want any surprises to happen at closing or anything to happen down the line. All right, so we talked about debt to income ratio. So now let's see what we got. So funds for the down payment, once again, you need to know, we talked about this, you need to know your price point. You take your price point, you work backwards to figure out the down payment. Your price point, your loan program. So let's say we're looking at a $300,000 home. We know we're going to use a conventional loan. That's 3% down. That's $9,000 for our down payment. Then we have to figure out what our closing costs are. So folks would say, hey, use between like 2 and 7% of the sales price for the closing costs, right? I think that's dumb advice because 3% of $300,000 is $9,000. 7% of $300,000 is $21,000. So that's a huge difference in numbers. You need to know what the actual number is. Just talk to a lender. If you're in Texas, typically the number is like 3.5%, or in the Dallas market, if you're in Dallas, right? But just talk to your lenders to get that number. You don't want to do the dumb 3 to 3.5% thing. Realtors typically say that because they don't know any better. And they, like I said, they want to sound smart. I always say realtors like to talk about finance. They don't have a finance background, a little too much. All right. Okay. So pre-qualification. Oh, I think we got like 5 slides left. All right. So pre-qualification or conditional approval. So lenders call different things, but here's everything in a nutshell. If you did not have your credit pulled and you did not submit your docs for the lender to verify, if you have a conditional approval or pre-qualification or pre-approval, it's not worth the papers written on if the lender has not pulled your credit or verified your income. And if, like I always say, if you're too lazy to take 5 to 10 minutes to download your W-2s or get your tax returns and send to a lender, like you're not ready to buy a home. So like I never understand the people that are like, hey, I want to buy a home, but I don't want to turn the docs, so I don't want you to pull my credit. You're wasting everyone's time with that. And I can't see any scenario where I've seen pre-approvals that say, hey, credit has not been run. Like you're not going to get your offer accepted with a pre-approval or pre-qualification if you haven't even had your credit run. Like you're wasting everyone's time with that in that scenario. All right, okay. There we got 5 slides left. Things to avoid: applying for new credit, major purchases, paying off your debt just for the sake of paying off your debt. Make sure you still have money for the down payment. Co-signing on loans, even if you're not the primary on the loan, that debt still goes towards your debt to income ratio, because you're co-signing, meaning that you're equally responsible as the other signer on the loan. And so the lender will count that debt towards your debt to income ratio, even if someone else is making the payments. The only scenario is typically if someone's made 12 consecutive payments on that item, the lender will not count it towards your debt to income ratio. So if you're not met the 12-month, if that person has not met the 12-month criteria and can't prove that they met the 12-month criteria, that is going towards your debt to income ratio. Like I've seen scenarios where somebody is not as co-signed on the call like 3 years ago, has made no payments, but the other person was making payments, but they made them during direct deposit. Some were made like in cash. They made some large payments, and there was no way to verify these 12 consecutive payments. So the person got declined for it was a refinance. So it was a refinance. They had declined their refinance because they couldn't prove that the other person made the 12 consecutive payments on a car that they were not even involved with at all. All right, almost home. Almost home. And I'm going to show you guys how to contact me, get a free call and all that if you guys want to work with me here in the the Dallas market or anywhere in the United States, we are able to help you connect you with a vetted, savory individual. All right. Okay. Oh, we're at we're almost at 2 hours. Appreciate everybody that's still watching at the 2 hour mark. So you're searching for your home. Boom, your offer's been accepted. Make sure the lender can meet the timeline. Once again, there's an inspection period, like an option period, where there's a time to do your due diligence. The lender collects your typically some sort of like application fee, but that goes towards your down payment as well. They're most likely going to ask for refresh your updated docs, because your docs typically need to be within like 60 days old. There's going to be an appraisal to determine the value of the property, because the appraiser determines the value of the property, not the realtors. They do a good job of saying, hey, this is what we think the property is worth. But ultimately, that decision comes down to the appraiser. And that's important, because a lender can only lend you the lower of the sales price or the appraised value on the property. So if the property comes in less than the sales price, the lender will only lend you the sales price. Now you and the seller got to figure out what we're going to do with that delta. So if it's like a $300,000 home, the appraisal comes back at $290. You and the seller got to figure out what's going to happen with that $10,000 delta. Like, is somebody coming down? Is the price coming down? Are you guys going to meet in the middle? You got to kind of figure that out. There's going to be title work done. Title is going to make sure that the person that's selling the property owns the property. There's no legal issues, or the property is not jammed up or anything like that. And then you get the closing, you get the keys, voila. All right, so I think it's 2 more slides left, and we got a QA at the end. Key terms. Should you buy a home now? I don't know. That's up to you. You got a bunch of information to your disposal to make that determination. PITIA, principal, interest, tax, and insurance payments. DTI, debt to income ratio. Okay, we already talked about this. LTV, loan to value. Docs. So you're going to need your last 2 years of W-2s. If you're self-employed, 2 years of tax returns, 30 days of pay stubs. Self-employed, you're going to need 4 years tax returns. So if you're a W-2 employee, you may not need your tax returns. Only sending your tax returns if the lender asks for it, but typically, a lot of times they can just accept your last 2 years of W-2s. So you don't want to submit any more documents than you actually have to when it comes to the home buying process. All right. 60 days bank statements, and lenders have to source large deposits. Okay, boom, we're at the end of the slide. You guys stay. This is 1 hour and 40 minutes we were on here. Appreciate you guys. So if you're in the Dallas market, I'd definitely love to help you reach your home buying goals. You can schedule a call with me. If you follow me on IG, the link's in the bio on my Instagram. I should have had it ready to drop in the chat, but you can just email me at hello@houserichtshow.com, and I'll send you a link to schedule a one-on-one call with me, so we can get things worked out. If you know somebody in the Dallas area, I love to help them out as well. But honestly, no matter where you are in the United States, me and the company that I work for can help you reach your homeownership goals, whether it's referring you to a realtor who maybe as knowledgeable as me that you would hear talk for 1 hour and 40 minutes, whether you need help moving, packing, we can help you wherever you are. So if you're in LA, New York, don't hesitate to reach out, and don't hesitate to reach out. And so I'm not going to do these 1 hour 40-minute ones, but I'm going to get back to doing like the shorter lives during the week. So every Tuesday, I'll cover some sort of topic. They'll be a lot shorter, like 20 minutes. They'll be a lot shorter, like 20 minutes. And you can ask questions there. So if you know somebody that you think we get value, share my information, share the channel with them. Tell a friend to tell a friend. Like I do this to help folks, and also I do this honestly. It's a job as well. So I love, like I said, and the way you can repay me back is just refer me on. If you need some real estate needs, let me know, and tell a friend. Refer me to someone looking to buy or sell. Subscribe to the YouTube channel if you want some more free content. I got over 100 videos there. Listen to the podcast. Listen to the podcast. Click the link in my bio on IG to go there. And you can join my Facebook group. Like I said, I have a Facebook group. You guys got to ask questions in there, and I will answer them. But I don't just type questions for you guys to brainstorm with. I put out enough, content on IG and YouTube that you can get it from there. So that's it. If you got questions, let me know. My voice is getting hoarse. That was a long time talking. Feel free to put a thumbs up on the video. Kyle Coleman. Is that Kyle from Maryland? Okay, appreciate. I didn't know Kyle was in the building. What's up? And so, if you guys got any questions, let me know. I'll do a 10-second countdown. Oh, so 10-second countdown. So if you have a question, just drop like an X in the chat so I know that your question is coming, and then you can kind of type out the whole thing so you don't have to worry about typing super quickly. Thank you for taking time to educate us on the house buying process by you and your business people. Oh, appreciate it. Thank you for watching. Like I said, tell a friend to tell a friend. I'm going to do these every Tuesday at 8 p.m. Eastern, so an hour earlier. And they'll be a lot shorter. They'll be like 20 minutes. So boom. All right. So cool. Thumbs up the video. Appreciate you guys. Okay. Well, how can an unmarried couple go about buying a home if one's credit's better than the other? So so you need to make sure that you would meet the minimum criteria for that loan, but you would just apply for the loan. So like I would get with a the lender to figure out where you stand, or you can reach out to me and figure out like where you stand as far as the loan process. Because sometimes you may both not need to be on the loan. Another person being on the loan may drag down your ability to qualify, or may give you like a super high interest rate. So it really depends on your specific like scenario, right? I know that was a general question, but yeah, sorry, I don't know if that answered your question or not, but you got to really reach out to a lender or reach out to me in order to go over that criteria. So yeah, if you're on this live, if you go to my bio on Instagram, or if you just email me, or if you drop a comment on YouTube, or just email me at hello@housewithshow.com, take a picture, and I'll send you a link to schedule like a one-on-one call with me. To send the link to a friend or a family member, or phone. You can send it to somebody that you don't like either. That's all good with me, and we can kind of get things squared out there. So, oh, okay, it is. Wait, what's going on, Cal? And so, yeah, that's all I got for you guys and gals. This is longer than I thought it was going to be. So, I'll do my 10-second countdown. If you guys got a question, once again, drop an X. If not, I will log out of here. Okay, so question is, can we still use both incomes if one person is on the loan? Man, so I don't want to get this wrong. It depends what the loan program is. So if one person's credit is below the threshold, you can't use their income, unfortunately. I want to say there was a new update where they take an average. I don't know the answer to that. If you DM me, I will look up the answer for you. I can't remember that exactly, the answer to that question. So DM me and I'll find that answer for you. All right, that is it. Time to get back to work. Feel free to give a thumbs up to the video on your way out. Once again, share the information with a friend, schedule a one-on-one. Like I said, I'm here in Dallas, looking to build the business. I love to help you reach your home ownership goals. So that's all I got. So here's one thing. I'm going to log out when you guys log out, because here's the thing. On YouTube, more people watch. The watch time helps me. So if you guys just want to watch the video or just keep it playing, I'm just going to keep it playing too. So, but give a thumbs up on your way out. That boosts my morale and it lets YouTube know that I did a fair job. So I don't have anything else. So if you guys have questions, let me know. Well, when everyone logs out, I will log out as well. So I'll be right back though. Oh, actually, I'm back. Oh, so I'll talk about what's coming up next week on the channel. We are, I think next week I'm going to talk about new construction properties, maybe. Or actually, let me get back to my wife. I'm just at a chance. So yeah, I'm about to log on. I am out of this thing. So if people still watching me babble, I appreciate that. So I'm about to log out for real in 10 seconds. So if you have questions, speaking now, I'll forever hold your peace. 10, 9, 8, 7, 6, 5, 4, 3, 2, 1. All right, appreciate y'all. Thank you. How do I log out of this thing? More. Oh, end meeting. Did I log out? I don't know if this thing's still live or not. It must. I have no idea how to log out of this live. What in the world? Okay. It must still on freaking Zoom now.